What are the transaction costs of rebalancing investment portfolios? Have you ever wondered what it really costs to keep your investment portfolio balanced? Let's break down the transaction costs associated with rebalancing investment portfolios. When you rebalance, you buy or sell assets to get back to your target allocation. This process incurs various expenses that can impact your overall investment performance. Understanding these costs is key for effective financial planning and portfolio management. Transaction costs can be divided into two main categories: explicit costs and implicit costs. Explicit costs are straightforward and include brokerage commissions, bid-ask spreads, and taxes. These are the fees you see on your statements. Implicit costs are a bit trickier. They include market impact, which is the price movement caused by executing large trades, and opportunity costs, which representing potential gains you miss out on by not being fully invested. The frequency of rebalancing plays a significant role in determining transaction costs. If you rebalance monthly or quarterly, you will likely face higher costs due to more trading activity. On the other hand, if you choose to rebalance infrequently, you might save on costs but risk your portfolio drifting from its target allocation. Research indicates that an annual rebalancing schedule often strikes a good balance for many investors. For portfolios that incur higher transaction costs, it may be wise to set wider rebalancing thresholds. This means allowing for larger deviations from target allocations before making trades. This approach can reduce turnover and associated costs while accepting some tracking error relative to the target. Transaction costs can also vary by asset class. For instance, emerging market equities or illiquid securities often come with higher costs. This variation should influence your rebalancing decisions. Additionally, if you are rebalancing among active managers within the same asset class, selling outperforming managers to buy underperforming ones may incur costs but is necessary for maintaining your desired risk-return profile. The choice of rebalancing strategy is also affected by transaction costs. For example, a buy-and-hold strategy avoids these costs but may expose you to higher volatility. Some strategies define a no-trade zone, where small deviations from target weights do not trigger trades. This helps optimize the balance between cost and risk. From a financial planning perspective, managing transaction costs in rebalancing is essential. This includes selecting the right frequency for rebalancing, considering asset liquidity, and setting tolerance bands to minimize unnecessary trading. By carefully managing these factors, you can keep your portfolio aligned with your financial goals while controlling costs.